Welcome, everybody. This is the ESOP Guy, and we are on a journey to an ESOP. I'm so glad you could join us today and continuation of learning more about ESOPs. This podcast has been designed as a resource to help people that are thinking about an employee ownership, an employee stock ownership plan for their company. If they're thinking about that and trying to learn more, it's really designed to give some very key information compartmentally so that it can be done over a period of time. So if you're new to the podcast, thank you for joining today. Please check out our website at journeytoanesop.com. Today, we get the opportunity to kind of dig into a topic that it can be kind of confusing when we think about business valuation for ESOPs. One of the things we have to think about is the way that the valuation is actually established when you're doing the transaction itself. And so the primary way it's established is that it's a negotiated value between a sell side and a buy side. And so today we're going to dig into the business valuation and really look at the buy side support of the transaction. So as we think about that, what we're going to want to do is talk to an expert. And so we get to do that today, which is always exciting because you don't have to just listen to me. If you are wondering, and if you're watching YouTube, you'll notice that my face is all messed up. I did go to the dermatologist today, and so it is what it is. And I covered everything with a Band-Aid, so you don't have to look at it. But so if you're just listening to the podcast, obviously you're going to go jump on YouTube to check it out. So really, as we think about this, I want to introduce this person. I've been asking him to be on the podcast forever. His name's Adrian Loud. He has his own valuation firm. And Adrian, how do you pronounce the name of your firm?
Oh, good question. Censeo. Almost like with a K, like with a K. Yeah, it's tricky.
The way it's spelled, it's like some people say Censeo, and I didn't want to mess that up right at the beginning. So, all right. So he owns a valuation firm called Censeo. And they're a very strong ESOP valuation firm. They do other types of valuations, but they do a lot of ESOPs. He's an ESOP expert out of Atlanta, Georgia, has a great reputation in working on the buy side of the transaction. And as we get started, Adrian, I wanted to just walk into this a little bit because this is your very first podcast. Tell me what your very favorite movie is of all time, and tell me why as we get started.
So I was going to say Tenet, but then you did your most recent podcast, and I realized I can't say that one because it's way too confusing.
Well, that's because you're super smart.
No, I don't get Tenet, and I've watched it several times. If I'm going Christopher Nolan, it's probably Inception. But otherwise, I'll go with probably one that a lot of people go with, Shawshank Redemption. Just kind of that nostalgia that kind of is really the generation before you and me. There's no technology in it, and it's kind of like, all right, friendship at its greatest. I mean, so that's probably my favorite.
That's awesome. And I will tell you that tells me a lot about you, because that means you're a deep person and that you have deep thoughts. So anyway, let's move on.
like John Candy. Yes,
exactly. All right. So you are an ESOP expert because I just said you were, but tell us how you started working in ESOPs. Like, how did you get started in this whole industry?
Probably like most people, just by chance, by luck, really. If we go back, say 30 years, right out of school, needed a job. I got a job working with a small valuation firm, and he had one or two ESOP clients, and I didn't know the difference between ESOP and an estate valuation or anything else. It was just, it was something I had to sort of learn. So fast forward a couple of years, I left that little firm and went to a big public accounting firm, and they had a client that was considering doing an ESOP, and someone had heard that I had valued ESOPs in the past, so I became the local expert in ESOPs, even though I probably still had no clue. Yes, I had no idea what I was doing. And as it turns out, that company did not do an ESOP. But at the time, I was like, okay, I'm starting to get this, actually kind of interesting. And if it's done for the right reasons, this is pretty cool. So it's 30 years.
30 years goes by quick, doesn't it?
It does.
Yeah. So navigating through like some of the things that I want, and some people are brand new listening to this, so I'm going to be kind of very basic. is that the roles that everybody plays within an ESOP transaction can be a little confusing. So I'm just going to back up a little and just to explain that, and then we'll kind of get you into the discussion on the buy side. So the roles that come up are, you have the sell side team, and that's the company and the selling shareholders who are going to sell their stock are normally going to have a sell side advisor. That's kind of what I do. And then other kind of people do that. They'll also have on that side of the team, they're going to have an ESOP attorney who's going to be responsible to draft documents, again, for the sell side of the equation. But an ESOP transaction is an arm's length negotiated transaction. So you need the buy side. And the buy side starts with a trustee who will be the transaction trustee, which will be the financial buyer of the ESOP or of the shares that go into the ESOP. That person is going to need, or institution is going to need, a valuation advisor. And so that's what Adrian and his firm, that's what they do. And their role would be to, and on the buy side would be to evaluate all the qualities of the business and do a business valuation to support the trustee. So I want to make sure we explain that, where Adrian comes into the equation. We can call him the adversary. He's the enemy, but not really. They do basically a very good job. But what they're doing is they're an independent source of information to the trustee, so that the transaction can truly be passing the Department of Labor standards. So I just explained kind of that, but let's talk a little bit about, like, as you support the trustee, why is it so important for the trustee to make sure that they pick somebody, maybe your firm or somebody else? Why is it so important for the trustee to have that done in the right way?
Right. And I think what you laid out makes perfect sense, Phil. And, the trustee, I think a lot of folks, and I know you've addressed this previously on podcasts, a lot of folks may not realize that the trustee is ultimately responsible for purchase price, determining what the purchase price is or the value. So both at the time of the transaction, hey, the trustee is ultimately deciding this is how much we are willing to pay for the company. And then for the ongoing valuation updates, it's setting that stock value. So that's a big responsibility, right? It's maybe, I'm being a little biased here, but that's maybe the biggest responsibility that the trustee has, at least for the transaction, setting that purchase price. Probably prudent for the trustee to have somebody else, this kind of prudent expert notion, have a financial advisor, a valuation expert come in. In fact, I think the DOL mandates that, and you've got these process agreements the last several years that say, hey, you need to go hire somebody independent to help you with the valuation. So that's where we come in, is on that buy side, trying to help the trustee, like you said, probably initially establish value. So that's kind of the valuation engagement. And then that usually morphs into that financial advisory role, right? Where the valuation professional is now helping as far as looking at deal transaction structure and terms. Do interest rates make sense? Do some of the assumptions make sense? Is the dilution from warrants or SARs, is that reasonable? All the way to eventually likely issuing some sort of opinion. Telling the trustee, hey, we understand you're interested in acquiring the stock of Phil Hayes Incorporated, and we think the purchase price is reasonable, and we think all the terms are reasonable, and go for it. So I think that's in a nutshell what we're trying to do as the financial advisor to the trustee.
Exactly. And so bringing in an expertise to the trustee may have some experience but they need somebody independent and be able to look at it with the, you don't ever see a trustee doing their own valuation work, right? Or being their own advisor in that, do you?
It's been a long time since I've seen that. Thank goodness.
Yeah.
Yes. And I think a lot of trustees have valuation folks on staff, but still to have that independent valuation firm, that independent financial advisor working on the transaction, I think that's the prudent thing to do. And I think that between the DOL and the process agreements, I think that's what we need to do at this point.
Yeah. I think it's the right way to do a transaction, which when we start thinking about like that comment of the right way to do a transaction, what is being considered when I say that, I'm saying that for everybody involved. And obviously the trustee is going to have a lot of fiduciary responsibility in the transaction. And the selling shareholders are going to have responsibility as well. It's not going to go well if this thing does get pulled for audit and then there's a big problem later down the road. So having those people be in place, that the things that Adrian does actually does protect everybody in making sure that it was done in accordance with the Department of Labor, and so that you can avoid anything down the road that's problematic. A couple of things that you mentioned I want to kind of highlight and just jump into a little bit deeper is obviously there's a whole role of being an advisor as opposed to you're not just doing a business valuation, but you're helping the trustee make a decision based on a lot of different elements of a transaction, which a lot of times when people think about I'm selling my company, everybody kind of gets hyper focused on the actual sale price, whether that's the enterprise value or whatever you call it. But there are a lot of other elements of the transaction that Adrian alluded to, which would include the structure of the debt, the seller debt, and how that gets structured. What interest rates would be put into place, obviously, if there's going to be a warrant. So there's a lot of parts and pieces that have to be planned for to make sure that the selling shareholder looks at this whole picture, like all of these pieces together, both on their side when they're evaluating even going into a transaction, and on the buy side, really evaluating that from what the trustee is going to accept. And so planning is going to be very important. All of that gets brought together, and you mentioned the opinion, which is what we're going to call the fairness opinion
Right.
in a transaction, and that's going to be by Adrian's firm or a firm like Adrian's. That's going to be something that you're going to document for everybody. So with all of that, kind of those are kind of the parts and the pieces. One of the things that I always kind of will look at is there's a combination of things when you're putting together an offer, and then that's being reviewed by the trustee. And how do you evaluate the combination of, I got a purchase price here with a target working capital here, I've got a warrant payment here. Do you look at those separately, or do you look at those together, or how do you give good guidance or advice to the trustee when they're evaluating? If you just look at them just by themselves, it may not be the big picture, right?
I agree. I think you have to look at them in a totality. I can't remember. I think you had Will Rodriguez or somebody on a couple weeks ago sort of talking about the warrants in that regard, right? It's like the bad analogy is going to the car dealership and the dealer says, "Hey, I'll give you monthly payments of $10," and you're completely ignoring what the purchase price is, or if you're getting the steering wheel with the car. So yes, I think you have to look at a combination of the purchase price, what sort of dilution there's going to be. And I think what you and I are talking about, what you and I are accustomed to seeing is, hey, if the sellers are going to at least partially finance this transaction, they're going to take back paper with an interest rate, and presumably to help the company with cash flows, especially early on, because it's got all this new debt, right? It might be prudent to have a lower interest rate, but to compensate the sellers for the lower interest rate, okay, maybe they deserve some sort of equity component, equity kicker. So warrants, like you and I are talking about. So I think that dilution number has to be addressed. The strike price needs to be addressed. Another form of synthetic equity, stock appreciation rights, usually going to a management team. That needs to be addressed as far as how dilutive that's going to be. Obviously, what the interest rate is on the seller debt. We can't have an interest rate of 25% and also do 50% warrants. I'm being silly, but it gets out of hand.
Could be out of hand. Yeah.
It could be. So chances are it's going to be looked at some point down the road. So I completely agree with you. Kind of looking at all those pieces individually, but as part of the collective, that's critical to making sure that the transaction works for both sides, frankly.
Yeah. And so for folks that are listening and they're like hearing some of these words for the first time, my first comment there is just don't get overwhelmed. You just start taking in some of the what I would call the ESOP terminology, because it's not. I mean, we're kind of throwing out dilution and strike price and all these different terms. And first off, there's the big picture that we're both trying to make is like all of that fits together in terms of an actual deal. And when you look at some of those pieces by themselves, like dilution, for instance, is how much stock we're going to, or with synthetic equity, when we think about warrants and SARs, how much are we going to dilute the value of the ESOP shares to the employees? I mean, that's kind of a major issue for the trustee, because that's their job, is to make sure that they're taking care of those people. So when Adrian talks about dilution, what's happening is there's some level of interpretation of what dilution should be. And that's what's fun about ESOPs, right, Adrian? I'm like, there's nobody that told you that dilution should be exactly this, right, on a deal.
Unfortunately, no, that is the case. There's no guidebook.
Yeah. So you can have so what's cool about ESOPs, and it's also difficult, is that it's a trustee and a financial advisor's interpretation of what dilution should be. And some of it, I think, has a lot to do with maybe deals that they've done. Some of it probably has to do with the experience with the Department of Labor. I don't know. How do you do that? How do you gravitate towards understanding, like, what you're the advisor, so you have to have something for the trustee? I'm sure it's a combination of things, but how do you advise them on something like dilution, for instance?
Well, and I think you and I probably know trustees too that are just adamantly opposed to any sort of dilution. They just won't do transactions that have, at least on the warrant side, maybe a stock appreciation right. Rights
they'll do that. That's good.
Correct.
For them. Yeah.
But yeah, it's difficult. And, if I were to go back and look at all the transactions that we've worked on, I'm sure the dilution has been very different. But to your earlier point, purchase prices have been different. Mm-hmm. Interest rates have been different. So there's a lot of moving pieces there. I think it's part what are best practices as far as what are we seeing in the industry. It's part, we don't want to go down a rabbit hole unless you want to go down. We can go down the rabbit hole of sort of this internal rate of return type of analysis of,
sure,
to keep it in plain English. If we were to look at how much warrant dilution we permit or allow, and what kind of return that creates for the selling shareholders.
Yeah, all in rate. Yeah.
Yeah. Does that kind of jive with maybe, other alternative forms of financing? If it's, asset-based lending or mezzanine financing or something like that, do the rates kind of look like they might be consistent with each other? If they don't, if the rate looks too high, chances are the warrant dilution is too much.
Yep.
So that's another barometer for trying to check what's
That's a good answer, actually, because the marketplace, and now the rates are going up, right? So I would imagine that warrant dilution can be a little more acceptable, because you have to get a higher internal rate of return on the whole transaction. So not to get down to a rabbit hole, to me, the internal rate of return, for people that don't know what that is, it's basically if I could just get my interest rate on my seller note. So if I got 5% on my seller note, and that's all I got at the end of the payments of that note, I got a 5% internal rate of return. But if I reduce that rate and I make it up with warrants, then I could get a 10%, say, internal rate of return and make up another 5% or whatever the differential in the rate is. And so my all-in internal rate of return at the end with interest income plus the warrant payment would total a total internal rate of return. And so if I can get senior debt financing at 5 or 6 or 7% and mezzanine financing at, what do you think, double digit something?
Sure.
10, 12, 15%, whatever. Now rates go up, there's more opportunity for that. So I think that's a good answer on that. But I think the bigger thing I'm trying to illustrate is that your role is including a lot of things that have to be first off, you have to be able to advise the trustee on all of the aspects and fit it all together like a puzzle. And it needs to kind of also be relevant to the point in time that we are, which, as we just talked about, what's changed over the last year, interest rates. Other things change too that you have to be kind of aware of and be putting that in. So every deal can be somewhat unique. The elements are there, but they're unique that you kind of have to look at all that individually, which means, I guess, and this is partly a question, you can't just have some staff person work for you and jump in and be the advisor. Is that true, or how does that really work for you guys?
No, it's try as we might. It's very difficult to leverage these transactions because you do need the experience. I mean, I think to your earlier point, as far as these opinions that we're issuing, they're really addressing two things, right? One is, hey, are we paying no more than fair market value for the stock? So that gets back to our purchase price analysis. That second piece, what you're talking about there, Phil, is do the transaction terms make sense from a financial point of view? I mean, are they fair from a financial point of view? If we were to go out in the market, kind of like your analogy of going out and loaning money at 5%, are all the terms of this transaction reasonable enough that you can get somebody like us on behalf of the trustee to say, yes, this makes sense? And it takes a lot of sort of experience and time and education to be in that position to kind of know what's going on. It's one of those things where you've got a valuation background. There are some things that you just would not accept as an engagement because you didn't feel comfortable. You didn't have the experience doing it. I'm not a healthcare compensation expert, so I stay in my lane. But I've been doing ESOP work, as you have, for a long time now. So we've got this familiarity with kind of how these structures should look.
Yep. Yeah. And they play off one another, and then you learn things from people as you do, you do look at different types
Absolutely.
of transactions, which one of the things that we didn't mention is the concept of deal structure and putting like earnouts and clawbacks, which can come up from time to time. On your side, looking at that, can you kind of explain the justification for whether it be an earnout or a clawback type of structure on a deal? Why would you use that? Why would you advise the trustee to use that?
Yeah, good question. So I don't know if the 30-second background on earnouts and clawbacks helps. So what I think you're asking is, okay, the earnout would provide for the seller to perhaps increase the purchase price at some point down the road, and probably not far down the road, but maybe it's 2 or 3 years. And if you disagree, let me know, Phil. But it's probably a few year window, such that typically you'd see an earnout situation where the seller says, I like the idea of doing this ESOP transaction. I'm not enamored with the purchase price. I think it's perhaps a little bit on the low end. And the trustee is saying, maybe, but we'd like for you to prove that you can actually generate the cash flows that you're telling us you can generate. So the purchase price, again, may be a little bit on the low end, but there's upside for the seller in case those cash flows actually come to fruition. So that's the earnout scenario. The clawback scenario, I would think of it as almost the exact opposite. Maybe the trustee is paying a little bit towards the higher end of their comfort zone, is not too sure about cash flows and the projections, but is willing to go along with a slightly higher purchase price, but says, golly, if you don't hit these numbers, I'm going to need you to reduce the purchase price. So that in effect, we've paid a lower purchase price than what we've agreed to on the date of the transaction. So I think you see either one of those situations where there's negotiation that takes place and the buyer and the seller really just can't come to terms on what the purchase price ought to be. And if that's the case, it's probably appropriate to consider an earnout and or a clawback.
Yep. I think you nailed it. I think that is a great explanation. And I wanted to throw that in there because one thing is that some people just don't know that that could come out, I would hate for people to get surprised in they get through a transaction and the trustee says, I can't even get close to your price. The only thing I'll do is offer you a clawback or an earnout. So one of the things I try to do on the sell side is look at that as a potential issue going way early going into it and saying, you can kind of usually spot it if you see a tremendous change in the forecast. Because one of the things I always tell people when they forecast is like, history repeats itself. In general, history is you're going to have potentially new customers, but to go from an average growth rate of 10% to 30% or something higher, it's hard. You got to explain like how you're going to get there. So if they're going to do that and I'm like, look, and they really are confident, I'm going to support that, but I'm always going to say, hey, we are facing the possibility of having an earnout or clawback. And so then they know about it before you can get into it. I mean, and just like you, probably you learn from your mistakes. I had one deal a long time ago where it was like that came up and the client's like, I can't do the deal. And so a lot of money was wasted. And so you just kind of make sure that you watch for those types of pitfalls going into it.
Yeah. I wonder, Phil, if you and I are going to see a little bit more earnout and clawback structures in the immediate future, only because coming out of COVID, where companies' revenues might have been temporarily depressed or aided for all we know. I mean, some companies did really well as a result of COVID. And if there's not a great track record, and to your point, now we've got sort of a hockey stick in either direction. Mm-hmm. Does it make more sense to have that flexibility, to have the earnout or the clawback there to kind of actually see what happens over the next few years?
Yeah. And when you think about it, it's a fair proposition, because the buyer is not going to want to take the potential risk of that not happening, right? So if they overvalued it, it's fair that it would be adjusted back, in accordance. If the cash flow wasn't really going to come, then everybody gets normalized if you start thinking about it that way. So, yes. If I'm a trustee and I'm just a financial buyer, I wouldn't just pay fair market value. You just have to pay fair market value. I mean, it makes sense, but you are protecting the employees too. So I think the biggest issue is don't be surprised by it. I've used it, in a way that like, look, I think that I like the clawback personally, only because you start off with a higher number. And in this scenario, we used it and we incentivized the key managers with the differential and some portion of the differential on the clawback. So we built it into their incentive plan. And so that was effectively a good way to use it. And then, we'll see what happens, because we're still kind of going to see what happens with the forecasted cash flow. But
good motivation. Yes.
Yeah. So you can kind of like put all that together. And that's what's fun about ESOPs, because there's a lot of parts and pieces to thinking through a deal, and really understanding kind of the lay of the land. And partly this is why we do the podcast, because I want people to know about those concepts and whether whoever they're using as their advisor to be equipped to ask the right questions early in the process. So nobody is really surprised or they didn't know that was something that could be available to them.
Absolutely.
So talking about being surprised, let's jump into this one. Where, have you ever been like you get hired by a trustee and you're like, all right, kind of moving into it, but something just kind of came out of the blue. You were kind of surprised by the deal. You weren't expecting something. So, have you had those kind of situations where it's like, what did I get myself into, And I told you can't pick one of my deals.
No. Well, I'd be hard pressed to come up with one of your deals that was the issue. Although you and I, if we had a nickel for every time we've been told, hey, this is the most straightforward, simplest transaction you ever going to work on. No, I think every transaction has nuances or wrinkles. I mean, I think you're always going to. So, you doing a lot of sell side type work, Phil, I would say there's a huge benefit to the seller having someone, an advisor, because let's face it, the sellers don't often know what they don't know. and they're trying to run a company and keep it successful and sell it all at the same time. So as much as us evil trustee buy side people might complain
you are called that, by the way.
golly, just me specifically, or
no, all you guys. No, I'm just kidding. You guys,
all
are
of
great.
us. I mean, we need each other, right? It's really hard to do a transaction and do it accurately and reasonably and dot all the I's and cross the T's. If we don't have, both parties there with really good professional advisors. As far as surprises go, I've run into things where there's a manufacturer that claimed they had a facility in Chicago, and push comes to shove, it was an abandoned warehouse. Had a transaction years ago where, and shame on me, I've learned to address this issue so it doesn't become an issue, but the management team had no idea that an ESOP transaction was taking place.
Wow. Okay. Yeah.
Wow.
They just weren't going to tell him.
It was met the owner.
Yeah.
And did meet the next in charge, the heir apparent, and it just kind of assumed that person knew what we were there for. It was a bad assumption.
Yeah.
So things like that.
Well, sometimes people don't want to say anything about there's definitely like, when do you tell your key managers that you're going through the ESOP process? Because if you're just exploring it and you don't do it, then it can create some wrong expectations. But there's definitely a time to get them involved for sure. Going through, obviously, to make sure that they're aware of it, because they're going to be part of the whole succession plan.
Yeah. Otherwise it's, heck, I've had it pretty good, I think. I mean, it's little things. You mentioned sort of working capital disagreements. How do you define working capital? We had a unfortunate situation a few years ago where this was just after COVID. A seller's primary vendor, because of supply chain issues, said, "I'm so sorry, I'm not going to be able to get you the building supplies you need to fulfill your contracts for probably several months." And so at that point, everything just got put on hold and never got resumed. You never know quite what's going to come up.
Yep. Yeah. I mean, that's where I think you have to just look at it. I think for your standpoint, you just kind of look at it factually, evaluate, and then ask questions, and then, and then go from there. Hopefully their advisor sees some of the major flags and says everything before you guys even get engaged. Like, this is what you should be thinking about or concerned with. So you're not surprised. What about like just a difference in valuation numbers? Like if you're coming in at something super low and somebody else is negotiating something very high. I mean, have you had that situation where you're having a hard time getting the gap figured out?
Yeah, it's that comes up quite a bit, honestly. And you can go back and forth a couple of times, sort of holding your cards close to your vest and not disclose kind of what assumptions, but eventually sometimes you have to talk about, okay, well, what working capital level are you using, and what discount rate are you using? And oh gosh, you picked 6 public companies that we thought were just so different than what this company does that, no wonder you're coming up with a higher value. So again, usually if you've got good folks on both sides, good financial advisors on both sides, you're going to be able to reconcile those differences. Maybe not all the way, but close enough that it makes sense and it's still reasonable to go ahead and do a transaction.
Yeah. And to be honest, I mean, nobody really wants I don't ever want a big gap, but at the same time, I think you get a better transaction when you have somewhat of a difficult negotiation. Not like I want a difficult one, and I say that because both sides have looked at different things, and I think sometimes, the buy side can err on the conservative part, the sell side can err on the liberal part. But when you bring that together and you start compromising on this and that, you really truly are negotiating out, the very best fair deal. at the end,
Yeah,
if everybody can be reasonable.
it's tough too, because you on the sell side, you're dealing with people. It's personal for
Yep.
them, right?
Yeah.
I mean, this is their baby.
Yep.
This is something that they might have birthed and nurtured for, who knows, 25, 35, 40 years. And for me, I think I'm a pretty caring guy. Shawshank Redemption reminder. I've got to be somewhat, I've got to be apathetic to some degree, right? It's more of a financial issue, because that's all the trustee can consider. The trustee really can't consider the fact that, gosh, Joe does seem like a super nice guy, so maybe an extra turn on EBITDA is appropriate here. So it's difficult, because you've got a dynamic that we really don't have on the buy side.
Right.
And
Emotions are there.
Correct. Yeah. And I'm not sure that the seller purely understands that, hey, they're not being insensitive. They really just can't consider anything else. And so it's kind of tough.
Yeah, it is. And I think that's why on the sell side, it's really important to establish realistic expectations. And, but just like we talked about, there's a lot of ways, you can look at valuation in multiple ways. Like you take market approach and focus heavily on the comps. Honestly, I just look at cash flow for the most part, because cash flow is going to dictate more of a realistic value for the subject company. But ultimately, if they have an idea that that valuation is going to be much higher for whatever reason, you should blow that out at the beginning. But if they go into it like that, it can really make the deal difficult, because they're thinking they should get something. And the other thing, they need to understand, the sellers need to understand the other aspects that we talked about earlier, like what is working capital and why is that important? What are some realistic working capital targets that are going to be required? Because that's going to affect the net purchase price. And the all in, like what does that all mean to you? Somebody has to translate all of this in terms of what they actually are going to get out of the deal, and that's important. But expectations are really important, especially because of the emotional side. This is the only time they'll ever probably do this, sell their business, and you want it to go well. You want it to be positive, and you want it to be, at the end of the day, you want them to feel like they won, as well as the whole company and the employees. So,
yep, I agree.
I didn't hit this at all, but I would just kind of like to make sure that when we think about independence, like you're independent, what do you, to be the trustee's advisor, what are the qualifications that you have to have as a buy side valuation advisor?
Oh, qualifications, experience, education, I would say knowledge of the industry that you're, and that doesn't mean I necessarily have to be an industry expert, but if I don't know enough about the industry, I better make sure I can be a quick study if I'm going to accept this engagement. So ESOP valuation experience, I think is critical. This is, again, you and I have done valuation work for a long time. This is different than a divorce valuation or an estate tax valuation.
That's right.
It's still valuation, but there's a lot of stuff that is nuanced. So you got to understand that. I don't know. You and I have worked on stuff in the past, Phil. I don't know. There are some trustees that will require us to sign effectively independent financial advisor certification. It's usually a 1 or 2 page document. So it says something to the effect of, yes, I actually know what I'm doing here, and I do this for a living. But it goes beyond that to say, I'm not secretly employed by the seller, or have been employed. The seller is not my twin cousin. I don't stand to make any money off of this. I'm not issuing a fairness opinion in the hopes that I get paid. In other words,
it's not like a
success
reward for the deal, right? Yeah.
Right.
That's a good point. And some case law where people have gotten into trouble is where the valuation firm did work for the company and then they come back and they do the work for the trustee, and that's a big no. So and I think that's kind of obvious, but it definitely needs to be, you can't, I have people sometimes come to me and they already got a valuation from somebody, and not that firm would ever do it, but to me, that valuation isn't as helpful. I can use components of it. I mean, they've done some good work, but I got to do my own work to make sure I understand the way we're putting a deal together, because there's a lot more than just the numbers, right? It's how it's all getting structured. But on your side, that's important because you want to make sure that the trustee is represented correctly, so there is no problem. But then moving past that, you can become then the valuation firm that does and that's kind of what happens typically is you'll kind of move into the role of now doing an annual business valuation for the company.
Yeah, so and you bring up a good point. I forgot to mention those process agreements that we've alluded to a couple of times. Those agreements kind of entered into between the Department of Labor and various trustees. I think to a T, they all have language in there that says, the financial advisor to the trustee on a transaction has not worked on behalf of the plan sponsor or worked on behalf of the ESOP committee in a sort of a preliminary findings capacity. So yeah, that's really important. Normally, yes, if we're working on behalf of the trustee at the time of the transaction, these ESOP valuations have to be done at least annually. So normally we will stay on and become it's more of a valuation capacity as opposed to a financial advisor capacity at that point. But yes, we'll stay on, whether it's with that same institutional trustee or if the plan sponsor just decides they want to bring the trustee internal, chances are we're probably still staying on.
Yeah. And that's good for everybody. I mean, because you already have that experience, you built the files, cost effective. And you are building an ongoing relationship at that point with the company in the capacity of being an independent valuation firm to help make sure.
We've got clients that, gosh, I'm getting old here, I'm dating myself again, but we've got clients we've probably been doing the valuations for 20 plus years. So
yeah, that's pretty good.
Time.
Yeah, considering you probably started when you were 15, so. Because you can't be a day past 40.
Let's not talk about what I was doing at 15. I'm sure it was nothing productive.
No, that's good. But I think partly I say all that because the ESOP community is a bit small, and we are concentrated. We all kind of work. That's what we do. We just do ESOPs for the most part. That's what we focus on. So it's just helpful that you have that much experience, because it just builds your value in the process of doing the support work that you do. So we're almost out of time. Just kind of real quick, I would just say thank you again thank you for coming on the podcast. It took us a while to get you here. Any advice for people that are thinking about going towards an ESOP? Just kind of a thing that you see out there that it's important for people to know, because that's really the audience that we have, is people that are thinking about becoming an employee-owned company.
Not rocket science. It's cliche. I'm sure it's been addressed by you and others many times. You got to hire the right professional advisors. We had this conversation with a potential ESOP client last week who was a little alarmed by the fees that were being quoted from various service providers. And I started doing the math with them, and I said, I get it. I understand. It's a lot of money. I'm not doubting that whatsoever. But they all serve a hugely valuable purpose in this. You've got a lot of players in here, and they all serve a very important role. And you can cut corners and say, hey, I'm going to have Phil do several things at once, put on multiple hats, but you've got to worry about if there's going to be blowback at some point in the future because something went wrong. So make sure you've got the right professional advisors, and then probably goes without saying, but I'll say it anyway. I mean, I think the ESOP culture's got to be there before the ESOP is in place. It doesn't make sense to say, Now I want to sell my company. I try to sell it to private equity and strategics. Nobody's interested. So I'm just going to go with the ESOP because it seems like a good way for me to get out.
Yeah.
You and I see that too often, Phil, and it doesn't work long term.
Yeah. I like that you said that, because I see that too. And, we both probably have a lot of conversations with people, and, there's just a misconception of, if you're going to go that route and commit to it. And otherwise you're probably not a good ESOP candidate, because you got to be thinking a bigger picture. It's value, but it's culture and it's longevity and legacy, as opposed to, I just got to get my multiple and I got to get my money out.
Absolutely.
Because on a normal deal, you're going to get some of your money out on bank financing, but you're going to be hanging out on that seller note for a little while. So it's not going to probably be what you think it is. So
that's right.
Which I think is really good advice, Adrian, only because, people can waste a lot of time, and, let's just kind of get through the deal killers first. Like, if that's not going to work, then go ahead and do that. And that might be a better fit for you in terms of all the other things that you could do with your company. So
yeah, it's not a solution for everyone. It's a solution for certain companies and certain sellers and certain employee bases, and if it's the right solution, it's fantastic. But yes, you and I are not advocating that it's a one-stop solution.
Exactly. Well, hopefully somebody that's listening will be lucky enough to have you on the other side of the table someday.
Thank you, buddy.
Yeah. So I appreciate your time and your knowledge base and your expertise. I really do. And so for everybody else, thank you for joining today, and we'll see you on our next step on this journey to an ESOP.